Thank you very much, Kathy. Well, as you know by now, South Africa's economic performance contracted even further by 0.7% in real terms after some two quite impressive consecutive quarters of growth. That was the third and fourth quarters last year, actually the fourth quarter and the first quarter of this year. It was better than expected when it comes to what was out there. If you remember, the South African Reserve Bank had predicted in their most recent MPC meeting that they expect a contraction of 1.1%, although that was back in July when they made those announcements. Chief Economist on Africa and the Middle East at Standard Chartered, Razia joins us now to delve in more when it comes to what this data actually means. Razia, thank you very much once again for joining us.
Thank you.
Any surprises here for you when it comes to the data that we saw for the second quarter of 2022?
Well, certainly there was quite a range of expectations, but in terms of the year-on-year data, the broad-based market consensus was that we may be seeing higher growth. Let's not forget, it's not so long ago in the first quarter of this year that we had seen the South African economy outperforming relative to expectations, really surprising with the strength of its growth profile, and a lot of those expectations therefore needing to be reset somewhat with the extent of the downturn experienced in the second quarter. Now, we know that there were very specific reasons for that. We know the flooding in KwaZulu-Natal. We know the extent and severity of the load shedding towards the end of the quarter. Still, many market participants would have been taken by surprise by this data.
Year on year, you've already said that there was really tepid growth when it comes to the economic performance, barely positive, when it comes to looking at how it limped along by just 0.2% in real terms. How does South Africa compare when you look at other emerging and developing markets that you research in Africa and the Middle East?
Well, what stands out in South Africa's experience is, of course, a quarter ago we were all thinking this is good. South Africa's economy is on the road to recovery. It took a long while for South Africa to put the COVID experience behind it. There has been an uneven growth experience in that some sectors, construction, for example, still not recovering their pre-COVID levels. But there was a sense of optimism, at least, that that was still happening. Come the second quarter GDP figures, a lot of that optimism is unfortunately fading. The recovery from COVID having been very short-lived, if we take what Stats SA are telling us, in fact, with the latest GDP figures, the South African economy has gone back to below its pre-COVID levels. So that recovery from COVID, the additional growth that we had seen since COVID, turning out to be very short-lived. The experiences of other emerging markets are, of course, very different across the world. While we had seen, compared to developed markets, perhaps a late recovery from COVID, growth has in many instances been more sustained. The big concern, once again, is that the severity of the load shedding, some of the problems that the South African economy faces that just don't seem to go away, that is impacting South Africa's growth outlook in a much more meaningful way. Now, big picture, we know that we've already seen a technical recession in the US. We know that there's further Fed tightening to come. That our expectation at Standard Chartered certainly is that we could see a more proper downturn, if you like, coming through in the US later this year, partly reflecting the tightening that's already being put in place. This, of course, could mean increased headwinds for emerging markets across the globe. But South Africa stands out because the starting point isn't necessarily as positive as we had previously believed.
So how possible is a recession in South Africa? We've already seen JP Morgan predicting that Europe will have a recession eventually this year. What about us here as we are in the third quarter right now?
I think everyone was expecting that certainly in quarter-on-quarter terms we would see that downturn in the second quarter. This wouldn't really have come as a surprise to anyone. In fact, relative to some market expectations, the quarter-on-quarter downturn was not as negative as had initially been anticipated. From the high-frequency data, there's every reason to think that we do see some bounce back in growth. A recession, a technical recession at this point, is not our core scenario. However, because the starting point is not necessarily that good, the expectation also that we might only see weekly positive growth in the third quarter, that is simply not good enough. Big picture, the South African economy faces a number of structural issues, and the kind of growth that it's managing to deliver, unimpressive, weak growth overall, a lot of those expectations for the full year-on-year growth are likely going to be revised lower on the back of today's data. That really doesn't do anything to enable South Africa to meet its greater developmental challenges. There is an urgent need for debottlenecking growth and for dealing with some of those issues that have held back growth for so long.
Razia, what are your expectations in South Africa when it comes to the rest of the year, when you look at fixed investments, the constraints to growth, and the areas of growth that are actually there that we are not tapping into?
Well, a really interesting feature of the GDP data, as disappointing as the whole package might have been, was that gross fixed capital formation, or investment in other words, was still positive quarter on quarter, rising 0.5% quarter on quarter. Now that's important because if it's sustained, it tells us something that perhaps the growth picture could be improving. A big point of focus for us is what the investment in renewables, the act of trying to resolve South Africa's load shedding difficulties, will mean for the country's growth profile. Given the reforms that we've seen that are only just starting to impact, that may take 2 to 3 years down the line to fully impact the economy, nonetheless, if a more positive growth rate of investment can be sustained, this is ultimately what is needed to boost future growth.
Your thoughts on household final consumption in a period where we have experienced a high cost of living with inflationary pressures. What does that tell us about how the household in South Africa, the average household in South Africa, is actually doing right now?
So really another source of strength coming through there from household consumption expenditure, which we know accounts for about 65% of overall GDP. So this was important. Household consumption expenditure actually performing in a pretty firm way, contributing about 0.6% quarter-on-quarter growth. The problem, though, is we know that beyond that, fuel prices, even though there's good news for the South African consumer come September, but fuel prices had risen further. We know that there's almost certainly more South African Reserve Bank tightening to come, higher interest rates, which will dampen household consumption and expenditure further out. So yes, there are some elements of recovery, notwithstanding the load shedding, notwithstanding the impact of that load shedding on manufacturing and on retail. There were signs that the South African consumer in that post-COVID recovery still contributed to growth in a meaningful way. The question we should be asking ourselves, however, is about the sustainability of that. Now, ultimately, if the interest rate tightening, the front-loaded normalization, if you like, from the South African Reserve Bank helps to stabilize inflation, if we see more petrol price decreases, the likes of which are going to be seen in September, then that could ultimately be good for consumer spending. Even if we see an extension of social support come the February 2023 budget, that would be another positive. But outside of those factors, the risk is around the persistence of relatively high inflation, the fact that there will need to be further interest rate tightening, and that's something that could take the shine off that consumption story. So some elements of good news, but we really need to ask ourselves questions about the sustainability of all of this.
Razia, I just wanted to take this conversation away a little bit from the data that we saw today. Joe Biden and Cyril Ramaphosa, President of South Africa, they are meeting next week. What do you think they should be talking about in their deliberations in Washington? When you look at what's happening in Russia, when you look at the relations between the three countries, and of course the concerns that are there when it comes to trade and of course, the growth issues around possible recession globally?
Well, South Africa has tried to play a pretty robust role in terms of asserting its non-aligned movement credentials. It's tried to maintain a position of neutrality given everything that's been going on. However, we also know that it has been impacted by the Russia-Ukraine crisis. A lot of the commodity demand that might previously have gone to the likes of Russia, South Africa is in a strong position to be able to benefit from a diversion of that demand, provided that South Africa is still seen as a good location for new investment in mining, the establishment of stronger trade ties, and I think that issue of trade, which remains very important to the outlook, will be an important talking point in those discussions.
Razia Khan is the Chief Economist for Africa and the Middle East at Standard Chartered in London, UK. Thank you very much for your time and indulging me on that Biden-Ramaphosa question for their meeting. Thank you very much for your time.